Good afternoon, and thanks for joining Washington, D.C.-based Jennifer Shasma Associates in our Get Farsighted in 2020 Complimentary Webinar Series. As you know, the FAR, or Federal Acquisition Regulations, is a rulebook that the federal government must follow when making purchases. Our webinar series pulls from contract experts to explain each part of the FAR. It is complimentary and recorded. We'll post all the recordings on our website and YouTube channel, where we have over 300 government contracting webinars available for download. A special thanks to our webinar partner in this series, the National Veteran Small Business Coalition Education Foundation. Please visit their website to learn more about the organization. We would also like to thank our friends at Open the FAR for their sponsorship. If your organization is interested in sponsoring the series or one part, please contact hello@jennifershouse.com. We would like to let you know about some ways to reach government and government contractors through us. We offer advertising and sponsorship opportunities through our weekly newsletter and also in our webinar series. For pricing or to place an order, please email us at hello@jennifershouse.com. Okay, and now we would like to move on to learn a bit about today's speaker, Craig Stetson. You can find his information on the screen here. And today we're covering FAR Part 30 with Craig. Thank you so much for joining us today. We really appreciate participation in the series. The floor is now yours. Please let me know when you're ready for your next slide.
All right, thank you, Arnev. Hello, good morning, good afternoon, everybody. Thank you for participating. So today we're going to talk about the cost accounting standards, commonly referred to as CAS. And let's get started. Next slide. All right, just real quickly, a little bit about Capital Edge. My name is Craig Stetson. I'm a partner with Capital Edge. Capital Edge is a specialty consulting firm kind of scattered around the U.S. We deal exclusively with government contractors and government contract regulations. That's cost accounting, cost allocation, business systems, terminations, on and on and on, all the things that are unique to being a federal government contractor. And we work with clients and contractors of all shapes and sizes, very large to small and everything in between, and across multiple industries. We do a lot of work in the A&D, aerospace and defense space, the DoD market, but all agencies, all industries as well. Next. And actually, Arnev, we can just kind of go through these real quickly here. This is really just for information. Just a little bit picture of us here in the U.S. and where our clients are. We also have an international presence as well. Next. More about the types of specific services and offerings we provide. Next. All right, so we're going to talk about CAS, a high-level agenda here. What we're doing today is taking probably two or 3 days of an actual in-depth class and boiling it down to about 30 minutes. So it's going to be high-level. It's going to be kind of fast. So let's get started. An agenda here. We'll go over an overview and some of the basics of the cost accounting standards, where they came from and when and why and what they really entail. Then we'll talk about cost accounting practice changes and or CAS non-compliances and what that really means. There's a protocol or procedure to go through when such things arise. And then disclosure statements. What are they? When are they required? What type of information is actually being disclosed? So we'll go through that quickly as well at the end. Next. Overview and the basics. Next slide. Okay, so the CAS for a long time, and Like a lot of other things that are now a thing in government contracting, some senator somewhere, some politician was unhappy about something and then went to the GAO, and the GAO did a review or a study. And that was just the beginning of what eventually became a law and then was implemented through regulation, which is really how these things work and what happened with the cost accounting standards. So there was a congressional testimony. It was a Navy guy, an admiral, back in the late 60s. And there was concern about the government getting different prices from contractors simply due to inconsistencies in how their cost accounting and estimating practices were developed. So to try to bring some consistency across the board so that the government was getting a more consistent look at pricing across multiple contractors really for same or similar items. The cost accounting standards was invented or developed. There's a board, cost accounting standards board, that governs that. That was initially established in 1970 as an agency of Congress. About 20 years later, then moved into the executive branch. But their sole mission, even to today, is they have the as the bullet says, they're the sole authority to make, promulgate, and amend the CAS. And actually, in the early 1970s, when the standards were developed, it was that initial board that developed that. So if you want to go back in time, 50 years or so, you can look at a lot of the history, the initial CAS working group papers, to see some of the intent of the different standards. And actually, some of that is helpful still today, as a lot of this, like with government contracting, is not crystal clear, and some of it is judgmental or debatable. So it's sometimes useful to look back to what the original intent of the whole thing was at that time. Next. So in contracts that are contracts are what are covered by the cost accounting standards, not contractors. Is kind of a misconception, but actual contracts are what are covered by cost accounting standards. There are specific clauses. There's 7 of them. They all don't apply at the same time, but there are unique clauses, 52.230, 1, 2, 3, 4, 5, 6, 7 different clauses incorporated in contracts that are subject to CAS. And the general rules or requirements, obligations of these clauses are as follows. Comply with the CAS. Okay, there's 19 different cost accounting standards. We'll talk about those briefly in a few minutes. So we comply with the CAS. We disclose our established cost accounting practices, and then, like most accountants like consistency. So once we disclose an accounting practice, we need to be consistent in how we follow it. So we comply with the CAS. We disclose our practices, and then we consistently follow those practices. And then along the way, if things change, there are opportunities for the government to either seek price reductions or for contractors to seek equitable adjustments, wherein if cost under a particular contract increased for a legitimate reason, then the government will be obligated to pay those increases. So there's obligations on both sides to either seek reductions or seek price increases. And then slowdowns to subcontracts. That is something that contractors, procurement or purchasing groups would be responsible, among other things that the purchasing system is supposed to accomplish. It's the adequate, proper flow down of clauses to subcontractors. Simply to protect yourself, the prime, because if something goes wrong, the government is going to come to the prime, not directly to the sub, because that's where the contract sits. It's between the prime and the government. So the prime needs to have adequate remedies to be able to turn to the sub if the sub is ultimately the problem or part of the problem for which the government is seeking some relief. So proper flow downs. Next. So the CAS are governed, I mean, they sit in two parts of the FAR, Federal Acquisition Regulation. They sit in Part 30, which is the administration. And Part 30 is broken down as follows. It's really just a couple of sections in here, 30.2, which deals with, when it's applicable, when it's not, the types of clauses. And then Part 30.6, the administration. Okay, so when we have changes to our cost accounting practice, or we're non-compliant with our practices, or non-compliant with the standards itself, there's a process by which the parties go through to settle these changes or these non-compliances. And that's what Part 33.6 deals with. So FAR Part 30 is the first part, and then the second part is next. Chapter 99, otherwise known as the FAR Appendix, Appendix 1. So if you go all the way to the end of the FAR, once you get past Part 53, which is the forms, standard forms, there's going to be the appendix. And within Chapter 99, there's a little bit of redundancy between what's in Chapter 99 and what's in Part 30. So the applicability, exemptions, disclosure, statement requirements, that kind of stuff's a little bit redundant. But what's not are the actual standards themselves, verbatim, word for word, are in Part 9904. Also, there's several examples in this section as to what constitutes an actual change in practice and what doesn't. Measurement, assignment, and allocation, we'll talk more about that here shortly, but that's important. Those terms are important. I mean, that is really the baseline or the foundation of what is an accounting practice, a cost accounting practice. A cost accounting practice, deals with one of three things: how you measure cost, how you assign it, or how you allocate it. So if we start messing around and changing one of those three, likely that's going to be determined to be a change in practice, something to be aware of as a contractor if you want to change your cost accounting practices. And then educational institutions, they have their own parts, in Chapter 99. So if you want any information on CAS, outside of or within the regulatory framework, it's in FAR Part 30 and Chapter 99. Like I mentioned earlier, there's things outside of that. There's the working guide, the papers, working guidance from the CAS group, back in the early days, and other things as well. But regulatorily, it's these two sections of the FAR. Next. So types of coverage. Again, these are at the contract level. There's three types of coverage. There's full coverage, which means you must comply with all standards, all applicable standards, which at the moment there are 19 of them. Modified coverage, you comply with 4 standards: 401, 402, 405, and 406. And then third, no coverage. There are legitimate exemptions when certain types of procurements, certain types of solicitations, contracts are exempt from all CAS requirements, and we'll go through what those are as well. So, that's the third group, none. So full coverage, modified coverage, or no coverage. Next. So this gets a little tricky. It's much easier to draw on a board, but I'll try to, make this understandable. So segment levels, okay? These dollar amounts, these thresholds are applied at segments. So what that means is, let's just assume ABC company has a home office, and then underneath it, it has 3 operating divisions, 1, 2, and 3. And each of those operating divisions, they kind of do their own thing. They have their own management. They have, their own financial P&L type reporting. One makes machine guns, one makes microwaves, and the other does, whatever. So for cost accounting standards purposes, these thresholds, these dollar values, those are looked at the segment level. So in my example, to determine if a particular contract was CAS covered or what level of coverage, you would look at the activity in segment 1, for example, the machine gun business unit. What happens over in the sewing machine group or the other group doesn't matter. It's within that segment. So a single award of $50 million award, or $50 million or more, unless otherwise exempt, and we'll get to the exemptions here in a few slides, but a single award of $50 million or more is going to be subject to full coverage, full cast coverage on the spot. All right, so if we get a $60 million award, it's not otherwise exempt, that contract is going to be subject to all 19 standards. And let's say that we get that contract in February. And in June, another contract comes along for $5 million. That contract would be subject to full coverage as well, because it exceeded the threshold of $2 million, and it was awarded subsequent to the $50 million award in the same fiscal year. Similar situation, you don't have a single $50 million award in this year, but last year you do the look back in the last fiscal year, cumulatively you have greater than $50 million of CAS covered awards. All right, so last year we did $100 million cumulatively. This year, that same $5 million contract comes along. Same situation. That $5 million award this year would be subject to full coverage too, because you had greater than 50 million last year. So you're doing a look back, and a lot of the, if you're, a large defense contractor, this kind of doesn't matter because you're always going to be well above the thresholds year to year. But if you're dealing in that smaller to middle market, I've had clients where, from year to year, they kind of go in and out of full coverage or modified coverage simply because of this $50 million threshold. All right. So it's something to be aware of. And this can be important. You might say, well, who cares if I'm full or if I have a contract that's full or modified? Well, it makes a difference sometimes if you have a non-compliance and, for example, you're not compliant with CAS 403. Well, 403 is not part of modified, it's part of full. So the damages or the cost impacts resulting from that 403 non-compliance would be applicable only to contracts that were subject to full coverage. So you need to know really which contracts are which ones are modified, which ones are full, and which ones are exempt, if for nothing else, just to calculate properly what the cost impact might be. The modified coverage, you have to first have a single award, $7.5 million or more. That's known as the trigger contract. All right. And then anything after that, the $2 million is what applies again. Next. Some exemptions. Sealed bids. Negotiated contracts less than the TINA threshold, Truth in Negotiations Act of $2 million. So for years and years, TINA and CAS thresholds were always the same number, but they never occurred at the same time. One always lagged. Normally the TINA threshold would change and then the CAS would follow several months later. Well, about 10 years ago, 9 or 10 years ago, that all got changed. So now when the TINA threshold changes, as it recently did, well, not recently, it changed in July of 2018, but only through the final rule issued last week, was it, I guess, made formal. It's $2 million. So when the TINA threshold changed, as it recently did, $2 million, the CAS threshold automatically follows. So it's automatically invoked. The government really just needs to change TINA, and CAS automatically follows. So $2 million is the number. So another exemption is anything less than $2 million would be exempt from all CAS. Small businesses. All right. So at the time of award, if you are a legitimate small business, that contract is exempt from all CAS requirements and remains exempt through its duration, regardless of what happens to your size status later on. Foreign concerns, 401 and 402 only, prices set by law or regulation, commercial items, adequate competition without the submission of certified cost or pricing data. There's a general theme here. A lot of these exemptions, CAS really isn't relevant simply because there's a market out there that the government can look at to determine if prices are fair and reasonable, right? I mean, that's the whole idea with a commercial item. There's a market. Adequate price competition, same thing. There's a market, contractors are competing with each other. So just that competition, those market forces are going to cost. So the most common on this list of exemptions that you see are obviously anything less than the $2 million, small businesses, and then commercial items and adequate price competition are the common exemptions to CAS. Okay, next. So we talked a little bit about the history. We talked about how a contract becomes CAS covered and which ones are exempt. So assuming we have some form of coverage, either full or modified under a contract, here are the standards. There are 19 of them. All right, we'll talk a little bit about each one here real quickly. So just a table, 401 through 410. Next. .411 through 420. For those who are looking at this, you may notice there is no 419. So there are 19 standards, but they go from 401 to 420. Someone might be asking, well, why? What happened to 419? The answer is, when they were creating the cost accounting standards in the early 70s, 419 was out there in draft form, and it dealt with allocation of cost. However, 419 at that time was, I think, the fourth standard that was dealing with, the allocation of cost. So the powers there, they determined, well, that's too many. We don't need a separate, an additional standard dealing with the allocation of cost. So they eliminated 419, combined it in 418, okay, which deals for the most part with overhead and, service centers, how we allocate those types of costs. When all that was going on, 420 was already being drafted dealing with IR&D. So we have a gap. 419 doesn't exist. It's reserved. A lot of people don't know that. So consider yourself lucky. So 19 standards. Next. So these 19 standards are generally, categorized into 5 buckets. So the basic standards, which are also the same standards that apply to a contract is subject to modified coverage, 401, 2, 5, and 6. 401, consistency in estimating, accumulating, reporting. All that means is the accounting practices, your cost accounting practices as to how you accumulate and allocate cost need to be consistent with the same practices that you use when you estimate your price proposals and when you report cost. You can't accumulate and report cost internally using one method and then use a different method for estimating purposes when doing price proposals. So they need to all align and be the same. Consistency in allocating costs for the same purpose. What that means is you really have you as a contractor have a lot of discretion to define your cost accounting practice. And part of that is defining a cost to be either direct or indirect. So there needs to be consistency when costs are incurred for the same purpose in similar situations. They need to be treated consistently either as direct only or indirect only, not both. Okay, and the key there is same purpose, like circumstances. Okay, typically there's costs incurred that are treated as both direct and indirect, but they're in different circumstances and not for the same purpose. Unallowable cost, you have to exclude your unallowable cost, CAS 405, 406. Cost accounting period should be the same as your financial reporting, your fiscal year. There are exceptions for that. If you change your fiscal year, you can have a shorter or longer one-time, cost accounting period, but generally speaking, it needs to align with your same as your fiscal year. And then how we allocate cost. Allocation of home office expenses. Okay, we have a home office. We have, back to my example, 3 operating segments or divisions underneath. Well, the cost of that home office, need to make their way down and be incorporated in the pricing of contracts, at the segment levels. So there are methods as to how costs are allocated from the home office down to segments. Then within each segment, there are typically, a lot of, these segments will have their own G&A expense rate at that level. They'll have overhead expense rates, et cetera. So there are methods as to how you allocate within that business unit, those business unit G&A expenses to contracts. There's really three methods. A single element, I'm going to allocate, based on direct labor dollars, for example. Value added, which is a total cost input minus your subcontract and material cost. And then the most common that contractors use is total cost input, which is all cost except for your G&A. So really three methods to choose from within CAS 410. CAS 418, allocation of direct and indirect. This is the whole how your indirect expense pools other than G&A are developed. Your overhead pools, maybe your intermediate, service center type pools, if you have facilities or occupancy or HR, payroll, other types of things like that are allocated on different bases. 418 would deal with that. How do we compose the pools? What's in the pools? Are they homogeneous? Are they representative, to all contracts or all cost objectives of the activities that are being performed within there? And then what base do we use to allocate these pools to? Does it make sense? Is it logical? Is it fair and equitable to the government, really? That's 418. 420, IR&D, B&P is independent research and development and bid and proposal. The trick there is those are really treated internally kind of as a job. You're supposed to set up a separate project number, capture those costs at the project level, just like you would with a job, and then allocate them as part of your G&A expense. That's CAS 420. Next. Compensation. Compensated personnel composition and measurement of pensions. There's two standards on pensions. This deals with defined benefit pension plans, which, they're still out there, but certainly nothing like they were years ago. And then deferred compensation. The trick in deferred compensation is net present value. Okay, the value in today or in the current cost accounting period of an award that is due in a subsequent cost accounting period is captured and measured under a net present value method. Compensated personal absence, that's entitlement, really, as to when it gets recognized. A recent change there was the government's change a few years back, making sick leave a mandatory thing. So generally, contractors account for sick leave or accounted for sick leave on a cash basis versus vacation, which was entitlement, right? I, the employee, am entitled. The employer, the contractor, is obligated to pay it. So once that obligation arises, then it's accrued. So it's the difference between accrual and cash. There was a change there, because the government made mandatory now sick leave, so there would be a change perhaps to that, a cost accounting practice there as to when you recognize the cost, simply because, or based on when the employee is entitled to the benefit. Then the assets, capitalization, depreciation of fixed assets, really nothing, real fancy here. This is a lot of this is standard, GAAP type accounting, generally accepted accounting principles. Cost of money, that is something unique to government contracts. 414 really establishes the basis for including cost of money factors. They generally follow your indirect expense rate structure. So if you have overhead rates, you'd have a separate cost of money factor for each of the overhead pools. Same thing with the G&A. And then 417, what that says is if you're building your own assets, you're self-constructing a building, for example, you would want to include, or you may include, you're entitled to include cost of money as an overall element of that book value of that depreciable asset. Next. And then some other standards, just kind of miscellaneous stuff here. Standard cost, that refers to standard versus actual. Okay, so a lot of it's popular in manufacturing situations. Costs are measured and estimated based on a standard. So the trick there is to be able to measure the standard frequently, adjust it as needed, and be able to deal with the variances between standard and actual. Accounting for material cost, that's how do we take material, what costing method do we use to take it out of inventory and apply it to jobs. Insurance deals for the most part with self-insurance. How do we measure that? How do we assign it properly to the cost accounting periods? There really isn't much in there to deal with purchased insurance. That is very simple. It's just simply, it is what it is. The premium cost X, and that's your expense. Self-insurance is a little bit different, where actuaries may get involved and you have to come up with a method of establishing or estimating what the annual cost of such insurance would be. So that's a 10-minute discussion on the 19 standards. Next. But one point there before we go on, even though you may have contracts that don't have the CAS clauses, meaning they're not CAS covered, about half, 10 or so of the 19 standards are incorporated in some form or another in FAR Part 31, which deals with the cost principles. So all that's incorporated in FAR Part 31 is the provisions of the standards that address cost allowability. I mean, none of the other CAS administration rules as far as cost impacts or price reductions or anything like that would apply. It's simply how a cost is determined to be allowable or not is what's incorporated in the FAR. So to say I'm exempt from CAS, yes, you are exempt from the CAS and the administration, but some of the actual requirements of the individual standards make their way into your contract, contracts that are subject to FAR Part 31. Quickly here, mods, those values we talked about earlier, 50 million, 2 million, 7.5 million, all of that is determined at the point of contract award. So if we have a contract awarded for $1.5 million, that's exempt, right? Because it's less than the 2 million. And then during performance, a mod comes along for $3 million. What does that mod do to the contract for CAS coverage purposes? The answer is nothing, because those thresholds are determined at the time of award. So it was $1 million to begin with. We got a $3 million mod that takes it up to a $4 million cumulative value. That is not CAS covered, because the million at the time of award is what counts, and it remains whatever the CAS coverage was at the time of award remains throughout the existence, the duration of the contract. Next. Okay, cost accounting practice changes. We're going to go through these quickly. Next. So we have cost accounting practices. That's the whole purpose of the disclosure statement, is to identify the cost accounting practices. Does that mean we have to stick to those cost accounting practices forever and we can never change? The answer is no. We can change our cost accounting practices. However, there are some rules there. All right. So once we use a cost accounting practice to estimate a contract and we're awarded that contract, we're supposed to be consistent in how we follow those cost accounting practices through performance of that contract. So if we decide to make a change throughout performance, that's okay, but there's a cost impact exercise potentially, because the general rule is the government's not going to pay increased cost on a contract simply because you, the contractor, chose to make a unilateral change in cost accounting practice. I decide I'm going to change the way I allocate my overhead from direct labor dollars to direct labor hours. I can do that, but there may be some consequences in the form of a cost impact under the contract. So your CAS clauses require such a thing that, if you decide to do that, that's fine, but then you're supposed to give the government notice, prepare a cost impact under the applicable CAS covered contracts, and submit that to the government for discussion and negotiation. There's those words again: assignment, allocation, measurement, and allocation. I think that's next, or the next few slides. Next. Okay. So price adjustments. If you fail to comply with one of the standards, if you do not consistently follow your disclosed practices, then the government can seek price adjustments, downward adjustments. So if you have a fixed price contract and after the cost impact, the cost allocated to that contract is less, then the government may be subject to a price reduction, meaning you'd owe them money simply because you didn't comply with the CAS or you didn't consistently follow your practices. Same thing when you unilaterally decide to change a practice. Similar situation. So whether you make a change in practice or you're non-compliant, it really results in the same outcome potentially, meaning cost impact and no increased cost will be paid by the government under those contracts. Next. There's different types of changes. Required change. I have to make a change to stay compliant. Let's say a new standard is invented or created. I got to change my practice to be compliant. Okay, that's legitimate. My example earlier about paid sick leave. Okay, my practice forever has been to account for that on a cash basis. Now, employees are entitled to 56 or whatever that number is of sick day or so many days a year, hours a year. Of sick leave. Well, now I can accrue that. That's a change from cash to accrual. That's a required change. I have to change it to be compliant with this new rule. Unilateral change, that's a voluntary change on the contractor's own part. So required change, unilateral change. Next. Unilateral changes also then are in two forms. One's desirable and one's not. If the government believes that your change is desirable or beneficial to the government for a couple of different reasons, and it may not only be a reduction in cost over the subsequent reduction in cost over future contracts. It might be something else. It might just be more efficient, a better way to a more proper cost accounting. So in that situation, the government can say, yes, I agree, it's desirable, I sanction that change, and I will agree to cost impacts. The opposite of that is, no, it's really not a big deal to me, the government, you can do what you like, but I'm not going to pay any increased cost under the contract because of that change. Next. Mandatory change, okay, you get the equitable adjustment, you can get the increased cost. Discretionary change, I just mentioned that it's unilateral, it's discretionary, the government's not going to agree. Next. Desirable or sanctioned change that would be agreed to by your ACO, and you would be able to submit an equitable adjustment to get the increased cost due to the change. Next. Real quickly, what is a change? What is a cost impact? What's an increased cost? What is an increased cost? The general rule is the government does not pay increased costs due to cost accounting practice changes. If you have a fixed price contract and the allocable cost goes down because of the change, that's an increase. It's an inverse relationship, right? If you have a $10 million contract and you changed your cost accounting practice after award, and after the cost impact, it's determined that only $8 million is going to be allocated to that contract, then the government's going to say, hey, had you been consistent and used that when the contract was awarded, it would not have been 10 million, it would have been something less. So the fact that the cost goes down on a fixed price is determined to be an increase in cost to the government. So what would happen is you get a mod reducing the price from 10 million to something less. Cost type contracts, other way around, if cost goes up because of the change, then that's obviously an increase in cost to the government. Okay, next. GDM is gross dollar magnitude. That's a fancy term for simply estimating the cost impact under your affected contracts and submitting it to the government for purposes of identifying or not that there really wasn't a cost impact or an insignificant cost impact to your CAS covered contracts because of these changes. The next few slides talk about what's in there. I'm just going to kind of go over this real quickly because we're running short on time. But the GDM there really is no defined set way to do it. I mean, there are certain attributes that need to be in there. Contracts need to be grouped together, either fixed price or cost reimbursement type. They need to be categorized by agency, DOD, DOE, etc. There's a few other things, but the format is really undefined, so a contractor can decide kind of how they want to do it, or you don't necessarily need to include all contracts. If you can select 5 contracts, let's say, that represent 80% of the total activity, then it might be acceptable to the government to simply measure the impact, based on these 5 contracts rather than dealing with 100 contracts that really wouldn't produce a measurable result because you had 80% of the activity in those first 5. So undefined, but still with certain attributes or things that need to be aspects that need to be addressed in the GDM. Next. Okay, next. I got some extra slides in here for some future reading here, but we don't have time to go through it today. Next. Okay, so that's a quick look at changes in non-compliance. The thing to take away from that is, yes, you can make changes, but there might be consequences. If there's cost impacts, then you have to deal with the government to negotiate to see if you're going to be able to get the increased cost or not. Disclosure statements. Earlier, we talked about one of the main 3 requirements in the CAS clauses is disclosure. So the disclosure of your cost accounting practices is done typically through a formal form, a government form. Next slide. It's called the DS1. Okay, cost accounting standards board disclosure statement form DS1. It's a 40-something page form without any of the continuation sheets. So the continuation sheets are a way to add words and narrative to more fully describe. The disclosure statement itself is really a series of you check a box or ABC 1, 2, 3 kind of thing where you choose from a menu. It's required at the segment level. If you have fully CAS covered contracts, it's required from home offices or intermediate home offices or other segments that may be allocating cost into segments. They would need to complete certain portions of a disclosure statement if they're allocating cost down or over to the segment that has the CAS covered contracts. Okay, next. So just general concepts. What's in this thing? Your cost accounting practices. All right, we're going to disclose how we accumulate, how we allocate cost, what the composition of our expense pools and our allocation bases are, what's direct versus indirect. Right. Once we make that decision and disclose what's direct and what's indirect and how we're going to treat it, got to be consistent in how we do it. You have the option to choose, but then we just need to be consistent and follow the choices made. Otherwise, you're into this changes, cost accounting practice changes world where you can do it, but then you got to go through the process of calculating the impact and negotiating with the government. Okay, next. Everybody enjoy working at home, listening to your dogs bark and your children? Anyway. Here's the formal definition, some examples: measurement of cost, assignment of cost, allocation of cost. I mean, these are the types of things that are described in the disclosure statement, and here's some examples of each. Measurement, how do we measure our cost? Okay, standard versus actual, there's going to be differences there. How do we assign it? That means how does it make its way to specific accounting periods? If we change our depreciation methods, that's going to affect how much gets first of all, measured and then assigned to particular cost accounting periods, depending on the type of method you use. Allocation. All right, how do we allocate our overhead cost? How do we allocate our G&A cost or anything else? What's in the pools and bases? Okay, that's an example of an allocation. So if we start changing any of this kind of stuff here, that probably is going to be determined to be a change in cost accounting practice. Next. All right. So the disclosure statement is a standard document, cover sheet, certification, and then 8 parts. General information. There's slides after, we don't have time to get into them, that deal a little bit more about each of the 8, but you can see what it is. General information, as you imagine, that is general information of the contractor, what type of business you're in, cash covered sales, that kind of thing. Direct cost, what is direct and what's indirect and how's it defined? What are the principal types of each, of material or ODCs? Different types of labor. Direct versus indirect, that's that thing I talked earlier about. We have a particular item of cost, let's say travel, for example. There are situations where it can be treated as direct and indirect. So we'd want to describe those situations where certain types of costs are treated as both direct and indirect, and in what situations. Indirect, that's a description of all your expense pools, allocation bases, how they're allocated, what the metrics are. It's all your overhead pools, your G&A pools, any service center type things, really any kind of indirect expense allocation other than G&A. Depreciation, capitalization, other cost and credits. Part 7 is a long section. You want to get your HR group involved on that one. Deals with different insurance plans, pension plans, deferred compensation plans if you have them, and a rather detailed description of different aspects of the plan. So definitely an HR thing to be able to complete that. And then home office expenses. If you have home offices or intermediate home offices that allocate costs down, that needs to be fully described in Part 8. The methods of allocation, certain types of methods are applicable depending on dollar values. And as well as the description of everything that's being allocated and where and how. So it can be a rather extensive description, really depending on the complexity of the home office and everything reporting to it beneath it. So I think that's a high level, I don't think it is, a very high level look at CAS, FAR Part 30. Chapter 99, disclosure statements, very quick. Like I said, there's some slides after this that provide a little bit more information as to what each of these parts really means. And I believe that's it. Thank you very much.
All right. Thank you, Craig, so much for a great presentation. Really appreciate your time. And right here is his contact information. If you have any questions, you can reach him on his contact information on the screen here.
Yes, if I went over this. I did 2 days and 40 minutes. So if we want to have a slower discussion on things, by all means, reach out. I'm approachable. There are the 2 ways to get a hold of me.
All right. And if you have any questions about federal contracting or need assistance with any of our services, please contact us directly. Thank you again for joining us. This concludes today's webinar.
Thank you.